Yeah, and just to kind of add a couple sprinkles to that cupcake.
This is our 100th episode. All right, friends, welcome back to Market Shares. I'm your host, Tony Blodgett, and I'm really excited about this episode, mostly because my friend Addy Nett is back, but also because this is our 100th episode of Market Shares. And if you go all the way back to the beginning, not only were we not quite as smooth and comfortable in front of the camera as we are today, but I was sitting right here with this guy, Addy Nett, for episode number 1.
That's insane. 100 episodes. Your consistency, a lot of respect there.
Well, thank you.
A lot of respect. I think that day too, we had literally spent a couple days putting together that studio. So there was some iron or things that needed to be ironed out a little bit.
Definitely some things that needed.
Side.
Yes. Well, and the reason I wanted to have you on for the 100th episode is because I owe you a huge amount of gratitude for the influence that you had on me getting started with the podcast. I mean, it's really twofold. One, you helped a lot with the studio creation. You created this studio down here in Lake Oswego. I'm, as you might notice, not in our normal studio, but this was the studio that kind of kicked it all off.
Yeah.
You joining our team was, this was something you brought to the table, something you were already doing with the MLO podcast. And, you kind of pushed me on a few conversations we had. You're like, man, you need to be doing a podcast. The stuff that you have to say, I think people would be interested in hearing. And I said, well, but I don't have the studio. And you're like, I'm going to come up and we're going to build you a studio. Dude, I owe you a ton of gratitude. And it's been really fun working with you for these last couple of years. And like I said, you inspired me. You still inspire me. And I'm excited to have this conversation because I think there's a lot to talk about. We are at the very end of 2023. There's a lot going on right now. Yeah. If you're in the mortgage space, you're probably going into Christmas really excited about the Fed meeting that we just had. And I don't know. I think it was great news, but I think we need to tread lightly with what that means for us moving forward. We're going to talk about that. But more than anything, man, just glad to be down here in the studio with you again. And you mentioned consistency, and my main thing when, one of the things that I was challenged with before I started this podcast is who is my audience? Because I feel like I have content that could be relevant to, home buyers, content that could be relevant to loan officers, both new loan officers and top producing loan officers. I feel like, a lot of my strength is in leadership because I've been in executive leadership for so long. And that idea of who's my audience kind of paralyzed me, honestly, to get started with this. And so I've decided that I speak to all those people. And so as you watch through our episodes, we talk about, going over training for, brand new loan officers, what you can do. We have guests that speak to that, but all the way up to seasoned veterans, leadership conversations that we've had this year, and then other areas of real estate investing and so on and so forth. Yeah. And so I guess the reason I say that is because if you're struggling with content and you need to do it, I just spoke on my last episode about, we met with Zach and in his journey with content creation. So I guess my after 100 episodes, I would say don't worry so much about what your message is and just be consistent. My big thing was I'm putting out an episode every single Friday, and that's what we've done. And we still have lots of room to grow, I think, as a podcast and as a platform, but just getting started. And I can't believe myself that we've already made it to 100 episodes. So it's cool.
Yeah, that's a lot. I think consistency, even backpedaling a little bit, the audience piece. I love that you say that because I always like to open up with there's going to be a lot of good takeaways for anyone that might be tuning in today. So yeah, if you work on the lending side, you're an agent, you're a home buyer, maybe you just bought a home and you're stumbling across it. We're going to recap a lot of things that happened in 2023 and what we think is going to happen in 2024. So don't just unplug if you're like, oh, I'm a home buyer, Addy's going into stuff that's over my head. There's going to be a lot of really good nuggets.
Yeah.
But even, in this journey of creating the studios with you and being at least an advocate of content creation. There's a lot of great people within our company that do it and do it consistently. Let's say you're not a content person.
Yeah.
Because I think that's what's cool about real estate is you can do this business and be of value to your clients in so many different ways. You can have the schedule you want. You can have the style. You can have the value add. So even digesting content or not doing a lot of content, you can take these nuggets and apply it to your service approach.
100%.
And I think that's forgotten about a lot.
Yeah. Yeah. I mean, I think that creating the content is one thing, consuming great content and taking nuggets from that you then implement in your business is probably the most important thing to do. And I'll be honest with you, that's what I'm doing here, right? I mean, it was my, it was the content that I was taking in and watching that inspired me to do this in the first place. So, and some people are I think they take in too much content without taking any action. I think both are important. You have to know what's going on out there. I don't watch the news to get my information. I watch podcasts. Pretty much YouTube is where I go to get any news that I want to get on specific topics from the people that I like to hear it from. And that's the great thing about the world today. But then you have to take that information that you're taking in and use it in some way, form, or fashion so that it's actually valuable to you and your business, right? So,
oh, God, it's so true. And I don't want to keep getting too long-winded on this because we want to get into our agenda.
Yeah.
But I think it's an interesting space for us to be in as lenders and real estate agents with the power of social media and influencing people. And you have to make a decision on your content style being, hey, are you just trying to get likes and comments and go viral? Or are you trying to educate and provide value?
Yeah.
And it's very clear if your success gauge and measurement tool is the likes, the comments, the shares, you're likely going to be leaning toward not very valuable content.
Yeah.
I'm not trying to be negative, but I want to be encouraging to people that maybe have been super consistent this year. They're doing the reels, they're doing YouTube or podcasts, and they're not getting a lot of likes or a lot of engagement. It's not about those likes and shares. It's about the quality of the people that are actually digesting your content and the value that you're bringing. So I think that hopefully that's taken the right way because I see that a lot. Even like I've been doing our podcast for almost 5 years. We don't have 1 million followers.
Right.
We maybe have 200 to 300 listen throughs on our podcast a week. That's not a lot, but that brings a lot of quality people that actually reach out from that. And that's all that matters.
Well, it's funny you mention that because I too, obviously, you can't not look at your views and your likes and your shares and all that stuff. I mean, that's the dopamine hit that we're all looking for.
Oh, totally. Yeah.
But I'm shocked at how much feedback I get from people about the podcast that I'm not even sure. Look, the way we do content creation was really inspired by you, which is we do a podcast every single week that I hope brings value to whomever's watching it. We try to go deep with our commentary, what we're talking about, and have it be relevant to the marketplace. But we also extract from that shorter versions, reels and different things that we can repurpose around different areas of social media. So people often will say, "Hey, man, your podcast is awesome." I'm like, "You probably didn't watch the podcast. You probably saw a clip of me here or there." But the reach, when you add together LinkedIn and Instagram and Facebook, plus the actual podcast on YouTube, and now that you've helped us get on all the other platforms, we are getting, listens and stuff there that people find us. It's shocking to me how much positive feedback we've gotten. And I look at the number of views and sometimes I'm like, man, that's all we got. But it is interesting how that reach just kind of seeps into the marketplace more than you know.
Well, and too, especially this year has been an ultra competitive year to get business, right? Whether it's referrals or interest rates or whatever it might be. Now, people are smarter and the accessibility to technology is so easy now with phones and all the obvious stuff. My point is they're checking out who you are.
Yeah.
So even if you're providing one quote on a loan estimate and you're competitive, they're Googling your name. You bet your bottom's dollar. They're hitting tab and they're Googling your name. What's coming up? And
while they're talking to you, probably.
Probably. Yeah, that's even a good point, right? So the fact like, hey, if you're consistent, like we'll bring it back to the barn here. If you're consistent and you're hitting these different platforms. It's just one extra box for them to check. Be like, wow, if this person has, you know, the integrity and the confidence to create content and be consistent with it, they must be pretty good at their job.
Yeah.
So it's a good checkpoint. I mean, we even do a ton of content just on YouTube for specifically out-of-state relocation. And my podcast, the MLO podcast, really serves as a final catch net because they reach out through YouTube, they watch our content, they schedule with us, and then they're Googling my name. They're still background checking.
Right.
So having that is very, very important. But let's go into kind of a 2023 recap.
Let's do it.
So Tony and I were chatting before. It was like, hey, what do we talk about? What's going to be important? And one thing we both agreed on bringing up is, hey, what has been the dynamic changes in the market? And this is for agents. This is for lenders. This is for home buyers and homeowners. What have we seen dramatically shift from 2022 to 2023? Obviously, everyone knows interest rates went up, right, Tony?
Yes.
That was a big gut check.
Well, and I think it's important to spell out that 2020 and 2021 were, you know, unicorn years, right?
Sure.
For the mortgage and real estate industry, because interest rates dropped so low because of COVID. There was the great migration. A lot of people were moving. They were working remote. That freed them up to maybe move away from their place of employment. I mean, that drove a lot of transactions. The interest rates drove a lot of refinances and really lowered affordability. So many factors that make 2020 and 2021 unique and different. And that really went, in my opinion, until the end of the first quarter of 2022. So 2022, in my opinion, was really that transition year. And then we kind of settled into the current market, if you will, all throughout the later half of 2022 and through 2023. So yeah, I think it's, you know, that stark contrast between what we experienced there, kind of the, like anything, when you go through change, it's like, is this really changing this much? Is it going to change back? Is this temporary? It's like, oh boy, it's not temporary. Matter of fact, it's worse than we thought as it relates to rates. But you know what didn't go down was home values, which is interesting. Slight little dip, in 2022, but that rebounded. I mean, home values up, 6%? Depends on which report you look at. But, 5, 6, 7% in 2023. No one expected that. Matter of fact, lots of doomsdayers out there talking about home values coming down, but affordability, no doubt, has gotten worse throughout 2023. But less talked about is the wage growth has happened as well. So, you can't just look at the home values and the interest rates and say, man, it's so unaffordable. True, but wages have gone up. Now we'll see if that continues. But minimum wage went up, and then that has pushed everything up. The lack of good workers in the marketplace, especially in the end of 2022 and 2023, drove up wages as companies were really searching for, attracting new employees, retaining their employees, all of that. We saw it in the mortgage business for sure. I mean, look, when we had so many transactions in 2020, 2021, we were paying tons of money just to attract people over. Well, that was happening in other industries as well. So anyways, I think that everything needs to be put in perspective. But yeah, let's talk through kind of what 2023 was like, and then let's make some predictions for what we think 2024 is going to do. Yeah,
just to unpack the home value thing, because I think that's really important and can confusing to the consumer, right? A home buyer, a homeowner. I was like, really? Why are they maintaining or going up, right? So what you have when interest rates go up, the demand to purchase a home goes down because the payment is much higher. So 1% in payment can impact, or 1% in rate can impact your payment, depending on the loan amount, $200 to $500 a month. And we saw an increase from 3 to 8%. Right. That is massive in 18 months.
Yeah.
That is a huge upswing, right? So people who are listing their homes, it's a very small bucket. I've seen divorces as a big one, job relocation, and financial hardship is really the main three reasons. And it's because homeowners who are sitting in their home, they're like, well, My payment's only $2,500 a month, $3,000 a month. Why would I sell and then absorb a massive overhead increase?
Yeah, it's a huge lock-in effect, right?
Yeah.
With interest rates being so low. And even for those buyers that might want to move up, some of them can afford to do it, but they're like, maybe I'll keep this home as a rental,
Right.
because rents are so high, my mortgage is so low. All of a sudden, maybe they had no aspirations of being a landlord, but just when you pencil it out, you're like, gosh, this is a cash flow situation right out of the gate. So people are even converting their departing residences into rentals instead of letting those go on to the market. And then you couple on top of that, of course, the institutional. This is a whole nother conversation. We don't need to get into it today.
Okay.
But the amount of institutional purchases that were happening from the BlackRocks and the the big hedge funds purchasing single family residences over the last few years. Matter of fact, there's some potential legislation coming that's going to try to force them out of owning single family real estate, which it'll be interesting to see if that happens, how that happens, and what would that do to home values if the big hedge funds are forced to unwind some of their real estate holdings of single family residences. I don't think it was as big up here in the Pacific Northwest, but there's whole communities that were purchased by hedge funds, and the amount of inventory that could unleash.
That's a whole episode,
dude. It could be great for home values, but it could be great for affordability, because you would think in theory home values could potentially, I mean, look, it's a supply and demand market. So if there's massive more supply of homes available, I mean, economics will win out. The question is how much inventory would that really be, and would it drive down values? I don't know. It's not something I would hesitate to purchase a home because of, but it's something that's out there and needs to be talked about. But anyway, back to your point, is that it is the scarcity of available homes. It's the lack of available inventory that has been propping up the values. And as I talk about something that could potentially unleash more demand, here's the other thing that we need to talk about, is that the demographics of the primary borrower, that would be in the age group of 28 to say 33 years old, right? That millennial 28 to 33, that kind of 5-year cohort is the largest amount of home buyers potentially that we've ever seen in history. So it's not like we have, we need more supply, because as of the way it is right now, the builders aren't building enough homes, and there's more people that are going to want to buy homes than ever before, and there's not going to be any inventory for them. So I personally think the letting go of these hedge funds and big investors like that should, in my opinion, should not be owning homes in the middle of all of our community. I mean, home ownership is great because of what it does for your community. It's one of the things that I see, is that it creates great community, people that are vested in their neighborhoods, and so on and so forth. So I don't think that, necessarily hedge funds should be buying up in those markets, but, anyways, we have forces on both sides of this, I guess, is my point, is that, if interest rates come down, that's going to help affordability. We have a huge amount of people that are in that prime home buying age. As of right now, I see nothing that's going to really unlock inventory. If rates got into the 5s, that lock-in effect could loosen up a little bit.
Sure.
And then we got this X factor out there with potential hedge funds and whatnot. So that's kind of the landscape that I see ahead of us. But I'd like to talk through, look, you still originate every day. I don't. What are some of the things in 2023 specifically that you experienced with the buyers you were working with that's different than what we had in 2020 and 2021, and how might that change, do you think, as we move into 2024?
Yeah, I think the number one thing to note would be the closing costs. So just to break that down, you see a massive increase in just the cost to close a transaction. And it's not personal. Home buyers, agents, lenders, it's not personal. It's everyone's trying to run a business, right? So the biggest jump primarily being in the cost to essentially lock in your interest rate. So that term is referred to as a discount point, or assessed charge for the rate lock. And I would say at least a 1% overall jump of the sales price and total closing costs. Most people say like, 2 to 3%. I like to dive it in a little bit further, but you're seeing anywhere from 3 to 5, sometimes 6% in total costs to close and closing costs.
Right.
The big dip or change is it's been months now since I've had a buyer actually have to pay their own closing costs.
Right. So we're able to now negotiate the seller to contribute towards.
Yeah.
So even though home values haven't gone down, there's definitely been a loosening of the terms of which you can negotiate.
It's almost an understanding. And there was a transition period. There was like 6 or 7 months there when we were rounding the corner from 2022 to 2023 that there were sellers just refusing. No, I'm not paying. I'm not giving it. They're still kind of stuck in that old sunset, right?
Yeah.
Like,
well, not only were they not paying closing costs, they weren't even allowing you to do an appraisal, contingency or a home inspection. They like waive everything, and no way I'm giving you any cash. To now, it's like, hey, you know, we're going to incent you to purchase our home.
Yeah, there was a lot of late to the parties. Sellers where like thought they were showing up to the party and the keg was tapped.
Yeah.
And they still were stubborn about it. But that took a long time.
Yeah.
That took a really long time. Then finally enough people, primarily agents, are able to educate about this is what it's taking right now to close deals. You need to offer temporary buy downs. You need to pay for closing costs. This is what it's taking. And I think that was really, really huge. On a positive note, we were able to get a lot of government loans completed this year. One of my favorite loan programs, the VA loan for our veterans, which is a true zero down loan. They've earned their right to have that down payment covered by insurance for the veterans, was massive. But not only a zero down, but a fully closing cost paid. We just had a transaction that's actually, they signed like an hour ago, right? It was like a $585 purchase, zero down. We had $18,000 in negotiated concessions from the sell side. So we used that not only to pay for their closing costs, but to pay for a 2-year temporary buy down on their payment, this is massive, guys. Year 1, $500 reduction on their payment. Year 2, $250. Creates a runway for them to refinance, right? They literally, I think it was like $100 cash to close. Well, this is super. And not to mention, our operations team closed that in less than 14 calendar days on a VA loan. This is magical.
Yeah.
And I think that's fantastic. Fantastic story. But one thing to understand, guys, if you're sitting at home on the sidelines, you're like, great, that's going to be me next year. What we're going to run into is if interest rates continue to slide down, we're going to introduce more demand. And when you don't have the financial capacity to pay for your own closing costs, you kind of fall into a secondary offer consideration.
Right.
And it's challenging to be competitive. So I'm trying to be positive but realistic at the same time.
Yeah, well, look, I think the story here is that it was uber competitive when rates were really low. There was a transition period where you could then negotiate an $18,000 seller credit to help pay for your closing costs or buy down or whatever. And it's possible that time is coming to an end. And the reason why I think that time is coming to an end is because we don't have that inventory coming, but we are seeing interest rates coming down already. We're going to talk about what the Fed just did earlier this week, or I guess by the time this episode airs, it might be a couple weeks. But the point being is that there was a definite pivot by the Fed. But I want to go back to a couple things that you said. The cool thing about using the seller's funds for a buy down is that if you end up refinancing before the expiration of that 2 years, those funds do get applied to your principal balance. They're kind of held in an escrow account for you, and so you don't lose that. It's not like a use it or lose it. The other thing I want to touch on, and this is super important for people to understand, is you mentioned that the closing costs have gone up, right? People are paying at least a point, if not 2 points. And that's not that the cost has gone up. I mean, the amount of check that you're writing is higher than if you didn't pay those points, but you don't have to pay those points. What's changed is the amount of benefit you get from paying a discount point when rates are really high. So let me explain this just briefly, and I'll use round numbers. In a normal market, paying one discount point would typically improve your interest rate by about 25 basis points. So the rate would go from 7.5, let's say, to 7.25, and that might cost you 1 discount point. Like, that's not a rate quote. That's just an example. And that's pretty normal. What we see today, because there is no premium, so investors are not willing. So think about this. If I'm doing a 30-year mortgage, I'm going to expect that loan's going to be serviced by me for a period of time. Maybe it's 4 years, maybe it's 6 years, maybe it's 7 years. So I can look and say, look, if I'm going to collect 7.5% interest for the next 5 years, well, that's great. I can collect that over time. But if I give you a rate of 7.5 and I think that rates are going to be lower in 2 years and you're going to refinance and pay me off, well, then I want my money up front. And that's where you see the degradation of premium available for these higher interest rates. So all of a sudden, we have found ourselves over the last year in a market where you pay 1 discount point and you might see a full point reduction in the rate. So it's like 1-to-1 almost, especially in those higher interest rate bands when you start getting loan level price adjustments, like for second homes or for low FICO scores or all the things that can push your rate up. It pushes you into those higher coupons, which investors, they don't want to buy those higher coupons because, like you and I know, like the Fed just outlined for us, rates are going to be coming down, barring some, crazy event. And if I'm an investor, I don't have the confidence I get to hold your loan for 4 or 5 years and get my interest over time. So I'm going to need it up front. So anyway, that's part of the reason why closing costs have gone up. And it's part of the reason why almost every lender out there is quoting an interest rate with discount points out of the gate. Partly because they know the consumer cares more about the rate than they do the points, but also because in most cases, for the average homeowner who is going to stay in their home for 2-3 years, it would make sense to pay those points.
Yeah, and just to kind of add a couple sprinkles to that cupcake, you used to have the ability in a more flatline market to raise that interest rate and not pay points, which was a huge, great play. There's nothing wrong with that. But we call it pricing. The way the grid's all set up on your pricing, you might be looking at a 7% interest rate. And the only way to not pay points, it's priced intentionally at like 8.5. Maybe even higher. So they just make it impossible. And that is the tough piece to it as of this year. So you truly are having to pay some sort of...
Well, and to clarify, they don't make it impossible. It's just there's no bid for those coupons. Investors don't want to buy them. And so I don't think it's intentional on the mortgage company's fault. It's not even intentional on the market's fault. It's just the market. Everyone knows that those coupons don't have a lot of value, so I'm not going to buy them. If I'm going to invest in mortgage-backed securities, I'm buying the 5.5, or I'm buying the lower one, and so there's more demand there. And so I think that consumers get frustrated, loan officers get frustrated when they look at the rate sheet and they go, well, I just want to raise the rate a little bit to help my borrower cover their costs because they can afford the payment, but they don't have the cash. It's just not there.
Or even more commonly is you're stuck on debt to income ratios. So you have to have a certain interest rate in order to qualify for the loan. When you have a lot of volatility and the rates are changing, you might be right on the edge and qualifying for this or not. So if you're a consumer out there, don't forget, if you are working with an originator and they're like, hey, we have you at 6.99 or whatever it might be, a lot of the times there is a debt to income ratio with these high rates that they're battling. So you don't even have the ability to explore a higher rate.
Yeah, well, I don't even know the actual percentage, but I believe that it was somewhere around 25 plus, maybe 35% of potential home buyers that were priced out of the market due to affordability, just not being able to qualify. And what we see is those people are trying to just sneak in, and it's making transactions so difficult. There's no wiggle room. Everybody's pushing the limit with these high interest rates, to your point. But I think they're going to be happy that they did it, because my guess is home values continue to go up. Again, barring some crazy change that creates a massive amount of inventory. I think that we're going to continue to see builders building less homes, less homes available on the market. Baby boomers are not selling their homes like any previous generation. They were the largest generation before the millennials. And you would typically see these, people are living longer, they're staying in their homes longer. and it's just not freeing up the inventory. So to me, all that points to home values continuing to go up, and I think they could actually go up quite quickly if we see this huge drop in rates that people are predicting. So maybe let's talk about what the Fed said, what it did to the market, and I feel like there was a little bit of a overreaction to the Fed's move.
It's the spirit of Christmas, Tony.
Well, yeah, you sprinkle that in, right? And people get excited. But here's the reality. Now, I listened live to Jerome Powell's, to the Fed, the conversation where they did not change monetary policy. They did not raise interest rates or lower them, the Fed funds rate, that is. And then he does his statement, his very planned statement. Like there was like one word that was changed, and I think he was asked, at least one question, if not two, about, so when you added the word "and," like, what do you mean by that? Or, I don't even know if it was the word "and," but my point is one word. People hang on every single word that he puts in that statement. But then he goes on and does a Q&A where he's just kind of shooting from the hip. Now, he's very polished in what he does, but I'll tell you, if you listen to that Q&A, if you're in the mortgage or real estate industry, if there was ever a Fed meeting to go back, it's probably about a 45-minute YouTube video. You can watch it on YouTube. Go watch and listen to how he answered those questions. It's very telling, I think, to where the Fed's head is at. He was definitely implying that not only are they done raising interest rates, but he openly talked about the fact that they're going to be lowering them sometime in the near future. He was a little guarded, as he needs to be. But here's the thing that people, I think, don't realize about that. As much as it was a pivot from the way that the Fed has been speaking, and I think definitely points towards them realizing that, what I took from it is, if you remember back when inflation really started going up, right? The Fed said, "Hey, inflation is transitory," meaning it's temporary and it's going to go away as the market improves. Well, I think they were actually right. I just think that their timing was way off. So inflation came down, in part because the Feds raised rates, and they're like, we slayed the dragon, we raised the rates, and it brought down inflation. But a lot of it was just because of COVID, man. I said this on the podcast. We had 2 years of COVID, and we're going to experience a 2-year tailwind from that. And there was a lot of disruption in employment, people taking jobs, people not needing to take jobs because of different programs that were out there. So it was hard to get employees to come back to work. So that drove up costs for services. The supply chain issues, we don't even talk about the amount of container ships that were stuck in ports, and just all the issues with the microchips for the cars and all that stuff. I'm not going to revisit it. But as that stuff worked through, obviously inflation was going to come down. And so I think the Fed realizes that, look, it probably was transitory. There were some other factors. We did our job. And one thing he said that was very interesting is that we're going to have to start backing off or cutting interest rates before inflation gets to our target of 2%, which I took to believe that when you see core inflation get below 3. If there's a read below 3, I think the Fed starts taking action to start unwinding some of their Fed rate hikes, and then it's game on for interest rates. But one last point I want to make on this, and I want to get your take on it, is that the market, here's the thing, the Fed basically said, and there's a consensus among the Fed members, that you're going to see 3 rate hikes, or basically 75 basis point reduction in the Fed funds rate in 2024. What people aren't talking about is that the market had already priced in 4 rate cuts or 100. It doesn't have to be done in 4, but a total of 100 basis point reduction in the Fed funds rate in 2024. So even what Jerome Powell said, as much as it was a pivot and the tone was different than we've heard from him, he actually said a number that was less than what the market's already priced in. So take that for what it is. But anyway, what was your take?
I do think, just to expand on your ending comment there, I do think it's challenging right now too, because there's an underlying need to restore confidence in the country. So emotional levers are being tied as well. Like, there's just only so much a human can take of bad news. Like, where are we going? Let's throw another book on the shelf of the pending presidential election. So you see a lot of optimism start coming around and then finger pointing.
Yeah.
So I think rolling into this next year, though, the overall trend is going to be downward on the interest rates. I think it's going to be just as rocky of a trail down as it went up.
Yeah.
And it's important to know that, meaning like we're also sensitive now with like social media and, you know, Yahoo Finance and X and what Elon Musk says and what Trump tweets and all this stuff. And those actually move markets.
I know.
It's insane. We
crazy.
never used to have to deal with that. Another thing, well, I loved what you said where it's like, hey, we had 2 years of this huge COVID period, right? And now we're on 2 years of a correction.
Yep.
So it just kind of goes back to Newton's law of every action has an equal and opposite, right?
That's 100% it.
And the tough piece about it, just as a human, I'm trying to speak not as an industry person, is the reaction was really hard to digest. When everyone was handing us the country money and things were, at least we were getting extra treats during the COVID to feel good and things were rolling, money was flowing, Bitcoin was having huge, like you throw a coin at any well and you got 4 back out.
That's right.
That was fun. But the opposite reaction was, you know, oh my gosh, healthcare. Oh, the prices of home. Now interest rate, credit cards, gas prices. It was
Groceries. Hello.
And we also didn't help just with the culture of spending we have in this country, because we all complained from the entire start of the morning to the end of the day, but America continued to swipe credit cards. We did not stop. That's why the prices were so stubbornly continuing to go up and not going down. And I think those are just good perspectives to take into
Retail
account.
sales was just up again. Yes. At the time we're recording this, retail sales came out. I think it was yesterday, the day before.
That's my biggest concern, because in America, we're all get on the bandwagon of spirit of the holidays, and we spend, and everyone has an insane amount of access to consumer credit cards. So those new numbers that come out could be a little blip in the weather forecast of Q1, where they're like, well, guess what, guys? We spent too much. We got to tone this back. There might be a couple weeks, but that where rates kind of go back up again. But that's the volatility I'm trying to warn people of, where you could have these like little bad couple weeks.
Oh, yeah.
Next year. It's not going to be just sunshine and roses for the next year.
No, it's going to be volatile. There's no question in my mind that as these things, as rates come down, it's going to be volatile. And
Right.
the thing about interest rates, we joke in the industry, they shoot up like a rocket and they come down like a feather.
And it's hard to manage, man.
You know?
It's so hard to manage. And it's so hard to manage like your home buyers' understanding of that, because we have to educate people and warn them. And it's all about transparency and giving them the basics of like, oh, what was Tony talking about how interest rates work and the points and what closing costs. And us from the originators providing those updated closing costs so your agent can negotiate on your behalf and do what you can do so you're not blindsided. That's all. That's why good people are still in the industry.
Yeah.
And I think
That's why it's not push button, get mortgage. It's much more complicated than
especially
that.
Now. Especially now. It's going to be really important as the volatility continues to be a very, very transparent, educational first service provider. And I'm kind of chopping on my words because I do want to warn people, like, there is so many people in this industry that just will do anything for a deal right now.
Yeah.
And it's really unfortunate. I had a good conversation with my insurance agent who's been on my podcast, and he's like, oh man, Addy, you know, it was just really tough because I was doing this quote. Insurance has rapidly, I did a whole episode on that.
Yeah.
He was doing this quote for an agent and a lender, and on that side of things, they were just get it done, whatever it takes, guys. And he was stepping back and saying, this isn't a good investment for a first-time home buyer. they're going to drown with what needs to be done to the home, the roof, the inspection report, all this stuff. And I think it's important as a consumer to be mindful of people in the industry that are pushing you. If you're getting this like used car salesman vibe and they're trying to stick you in the financing room and get you just to say yes and sign with this Sharpie, and you're sitting there hangry and you just want to be done with it, dude, you're not working with the right people.
Yeah.
So it is very important as a consumer to pick people that are going to be honest with you. All the agents that I choose to work with, and I say that I choose to work with the agents that I work with, we're all on that same page. Hey, yeah, we all want to get paid. Right. We all have bills and a family to take care of. But in the end, we want lifetime clients. We don't want one transaction and then go back to the next, call and try to show a home and sell it right there. These are long-term relationships. So be mindful when you're looking online about people just trying to create maybe inflated urgency.
Yeah,
right?
Well, I mean, we just had a conversation. Well, first of all, it was hilarious that we saw, look, when the Fed spoke, stock market rallied, bond market rallied, rates definitely got better that day.
Yeah.
But when rates have been in, the high, the mid to low sevens, high sixes, depending on what, and all of a sudden people are like, I can't believe rates are back to 5 again. I'm like, what are you talking about? Like, the rates are not at 5. And so I think you're going to see a lot of that where people know that there's eyeballs out there looking at interest rates, and those people are going to try to put those, they're putting their lure out there trying to attract you into something that's really just not realistic.
Well, and like the reality too is like nobody, when the posting went crazy and people were, you got all this urgency, it's like nobody said, hey, rates are exactly where they were just in May.
Yeah. Stop it with the honesty.
Yeah.
Well, here's the other thing I want to caution people about, because you're right. Look, I love what you said, the way that you and your realtor partners treat each borrower. It's so important. It's never been about the transaction for me. It's always been about the relationship. I feel like if you help enough people with education and good advice, that at the end of the day, they're going to want to do business with you, and you're going to do phenomenal in this industry. And the same thing goes for as interest rates come down.
Right.
Here's something like I would love every consumer to refinance. Every time the rates drop by 25 basis points, we will do 6 refinances for you in the next 7 years. That would be, for business, that would be phenomenal.
Sure.
But for the consumer, that would be horrible and super expensive.
Yeah.
And so I think that loan officers, cautionary tale to you and to consumers, is give people great advice. Look, the reality is none of us have a crystal ball. Right. When rates get to a place where it financially makes sense to do it, I think you're going to start seeing a lot more of these no-cost refinances, because when we do get some premium back into the pricing, Addy, we will be able to maybe not offer the lowest rate that's available or even charge discount points, but go a little bit above that and have a premium to cover their closing costs, to where, look, we can improve your monthly payment without adding a bunch of additional principal to your loan. That's a smart thing to do. And you could do that a couple times. And that could be a win-win for both the mortgage company originating the loan, and it could be a win for the consumer. But be careful, because if you got an interest rate that's in the 7s, or maybe even, at the higher part of the market in the 8s, and you're like, I got to get rid of this right away. People, there's a mindset of consumer that I got to get out from underneath this high rate.
Yeah.
And look, maybe just be a little bit patient with the market, and let's do this when it does totally make sense for you. And I'm not saying, don't refinance your clients when the time's right. I'm saying be smart, get them real facts, let them know when is the break even going to happen if you refinance this now with the cost of what you just paid. And then look, what do we think rates are going to do in the future, and does it make sense to wait? So for some consumers, they took on a mortgage payment that is pushing them to the limits. And any amount of reprieve would be helpful. Hey, maybe help that person refinance them if it financially makes sense. But, we already have people reaching out saying, hey, we can lower you by a quarter, refinance today. And it's like, maybe just be patient.
I love that you brought that up. And like, I do want to throw an asterisk on my own kind of vibes today. I'm not trying to be negative about a lot of this stuff. What I want to do is I want to be positive, but I want to be realistic, and I want to be truthful to people. And the refinancing is a big one, because Tony and I were just talking to one of our colleagues where his client was getting spam called by a different mortgage company, and they were telling them to refinance. But the way we have it structured here is this high level of service of mortgage advisors. We are breaking down the cost. So we're looking at, hey, how much did we spend to acquire this first loan? We know, and we have a conversation about your current debt and what you're paying on all those stuff. When is it the break-even time? Because prepare for your mailboxes to be very full next year. Right. You're gonna get 2-3 letters a week minimum saying, "Hey, refinance now." But to Tony's point, it's more than just a yes or a no. This is a lot of money, and you want to make sure you're doing it at a very strategic way so that it's not a big waste of fees, right? Yeah. And this is another thing too. Consumers out there, homeowners, first-time home buyers, whatever it might be, the biggest thing you can do right now, and these are controllables, manage your credit. This is huge, because credit plays a role into what interest rate you get. So the more effort you can put into managing your credit score, not maxing out your credit cards, not taking on new loans, and maxing out your debt to income ratios, is going to make it a lot more streamlined when you're ready to refinance. It's huge. Do not look at your home as a piggy bank where you're just like, oh, I can go on this trip because I'm going to refinance and I'll cash out this 5-10 grand for this vacation and pay it off later. Those get very challenging because the interest rate and the cost just go higher and higher and higher to extract the equity. Yeah. And the wait period becomes harder to time. So just a couple of pointers and things we always do, kind of the financial oil check with our clients.
Yeah, look, I think that 2 comments on that. One, I think people think as long as they make their payments on their credit cards on time that they're going to have great credit. And the reality is that the relationship of your, as you mentioned, your credit card balances to your limit, that credit utilization is as much of a factor in your FICO score as making your payments on time. People don't realize that.
They don't.
They're weighted equally. So anyways, that's one thing to really keep in mind. The second thing I would mention, though, and I agree with you, look, the home equity that you have, which, by the way, home equity is at the highest level it's ever been in the history of the United States. Right now, equity is as high as it's ever been. I've told stories on this podcast about when I bought my first home and I was able to lower my interest rate, refinance, pull out some cash, consolidate some debt, and not only save a significant amount of money, but forever change my relationship with credit cards and how I utilize debt. That's a great story. And I tell it often because it literally changed my life. What Addy said is also right. Don't tap into your equity just simply to go on vacation or to go do something fun. But I don't want you, some people feel like, and maybe it's because they were told this by their parents or for whatever reason they have this belief that tapping into your equity is like as dangerous as tapping into your 401k. I don't think that they're the same thing. A 401k is a true retirement account. For some people, buying a home was an investment. There's some equity there, and used properly, you know, with a plan, with a financial, you know, with a mortgage advisor that's got a focus on helping you understand your overall financial situation. I think utilizing your equity in the right situation for some people is huge and could massively free up their cash flow. And the worst thing that I could ever see happen to someone who had equity is that they were so afraid to tap into it and they had other situations going on in their life that caused them to, you know, not be able to make their payments, ruin their credit, really not be able to refinance when they got desperate and ultimately, you know, lose their home, let's say. So don't be so afraid of having a conversation with a trusted advisor about, does it make sense for me to tap into my equity in this situation? And if they're a good lender like Addy is, they're going to tell you, look, these things make sense. Here's the math. These other things, I wouldn't consider that. So I wanted to say that because some people I've had say, well, there's just no way I would ever touch my equity. And it's like, it's not that sacred. It can be a tool as well.
It deserves a conversation for sure. Like I had a past client that we got him into an amazing interest rate when it was under 3%. And he came forward with a family emergency. And it was about a $30,000, we'll call it emergency / whoopsie. I'll call it that, right? and he wanted to do a full refinance, cash out, pay that off, and be done. Well, that would increase his rate from 3% at the time, almost 8%. Whoa.
Yeah.
Right. So in that situation, it was appropriate to do a HE loan or a HELOC and tap into that and keep that first loan at a great interest rate, but stop the bleeding for an uncontrollable life circumstance.
Yeah.
Right. So just a real story to add.
Look,
it's important.
I think that up until right now and until we see rates get better, the home equity line of credit or a HE loan or some other type of way of tapping into that equity if you really need to makes sense.
Sure.
There's going to come a time in the not too distant future where that crosses over.
Right.
And it's probably somewhere around interest rates getting into the high 5s would be my guess, which some people are predicting will happen in 2024. I'm a little less optimistic at this point that that'll happen, but
Right.
we'll see because there's another big factor, which is right now the spread between the 10-year and mortgage rates it's about 280 basis points. It was up around 300 basis points. It should be around 180 basis points. So I think that we can see some compression overall in that, in addition to the other factors that could lower interest rates, and maybe that pushes us into the 5s. The one other thing that I would say is a lot of this is going to, inflation is a huge factor on interest rates. There's no question. And we know inflation is coming down and coming down quite quickly.
Yeah.
The other factor is, the thing that could really push interest rates lower is if we have a recession. I'm actually starting to think the Fed could maybe pull off a soft landing here. I don't know. Time will tell. But if they do, rates will still improve.
Right.
But they won't improve as much as they would if we started seeing signs of a deep recession, like the massive job losses. Because keep in mind, the Fed's job is one of their half of their job really is job stability, right, and making sure that the unemployment stays low. So if unemployment starts creeping up significantly, or we start seeing a true recession in the economy, I think you get the double whammy of not only will the Feds lower rates, which I think they're going to do purely if inflation continues to go down, which it will. So I think the Feds lower rates there. The other piece of this right now is we're in quantitative tightening cycle right now, right? So the Fed is selling off their balance sheet quite aggressively.
Yeah.
I think they've sold close to $1 trillion off their balance sheet, and that's called quantitative tightening. And I think that, and Jerome Powell was asked about this in the Fed meeting. He said, we're not even talking about ending or changing anything with quantitative. It's not even a discussion. Well, it would be a discussion if we see a recession. And so I think right now the Feds are going to lower rates as inflation comes down. He said that.
Right.
But if we did see a recession, that's where rates really could accelerate. If we don't see a recession and the economy stays strong and employment stays strong, then I think we see definitely an improvement in rates, but not as low as we could. So that's why I interjected that, because that's the difference between, in my opinion, getting into the low 6s or getting into the high to mid 5s, is whether or not we see a recession. So
I do not.
I thought I learned my lesson last year of not predicting interest rates, but anyway, that's my take. That's my read as we sit here at the very end of 2023. So
I think there's no way in God's earth you're going to be hearing recession commentary next year. There's just
you don't think so?
There's no way with the election. You have two sides pointing fingers at each other, and it's not going to happen.
So the Fed was asked directly about the fact that it's an election year coming up, and he basically was like, we don't even consider anything political. Like he just dismissed that. Like, we have nothing. That doesn't even come into our thought.
I don't believe that.
Yeah.
And
I don't think anyone believed that.
Secondly, it's going to be a battle of just push notification headlines next year.
Yeah.
And it's going to be back and forth firing. No, we're doing this. You're not doing this. And I'm doing this. And there's that.
I'm so not looking forward to this.
But I do somewhat think you're right about the flat landing. I think I think it could really happen.
Yeah.
I think it could happen. The labor market, to me, I think it's just going to be a longer, painful process of how economics is changing.
Yeah.
Defining labor from a human is still being worked on.
Right.
That's the issue. And to me, it's not like, oh, gas is under $4 now. And I think that's the real big problem, where corporations are now finally recovering from their hangover of the good times and looking at balance sheets and like, oh, crap. Like, we really don't need all these people doing this stuff. Get rid of it.
Yeah.
Get rid of it, or use a computer, use a software. Yes, you have to say AI plays a role, but it's going to take some time for us to figure out what labor we really need from humans.
Oh, 100%. Well, and part of the labor numbers are skewed by people taking multiple jobs too. And
really? I didn't even think about that.
That's not sustainable.
Yeah.
One last thing on the Fed is he so badly wants a soft landing that I think that, well, it's good for us because I think what it means is he's going to pull up on that yoke, meaning he's going to cut sooner. I think as soon as you start seeing, like I just said a minute ago, when you see core inflation under 3, he's going to be like, okay, we're good. The soft landing. So it is going to play out, I think, in our favor, the fact that he's trying to stick this thing. So anyways, you guys, this got kind of complicated. I hope everyone followed along with this conversation because it's all super important stuff, I think. Especially if you're in our industry or if you're a consumer, this is valuable stuff. What else? Was there anything else on your list that we didn't get to that we wanted to wrap up with before we close out this episode?
I did have a couple things, but I think just the conclusion would be, if you're considering buying, I wouldn't get caught up in trying to time the windmill of the perfect interest rates. I think there's still a lot of opportunity right now, particularly you're saying like builders are stopping homes. Well, there's still homes that are completed for sale.
Yeah.
And you can get a lot of fantastic, we'll call them bargains. You can get closing cost cover. You can get seller paid buy downs. There's a lot of opportunity if you're in a position to buy right now. So don't be like, I'm just going to see what's happening with the election, because be mindful as demand goes up, the price, the competition, all those things.
So you agree with me that we're in a window still where you can get a seller to pay closing costs. Rates haven't significantly come down. They've improved.
Yeah.
A lot, but not probably to where they're going to go, but it still might make sense to buy today because you can negotiate with the seller better.
Yep.
Home prices, have softened. They're up year over year.
Yep.
But people aren't like shooting for the moon when they list their property. They're being more realistic.
Yeah.
I think we both agree that as rates come down, that tone is probably going to change, and it's going to get back possibly to less negotiation with the seller, maybe even bidding wars on particular homes, right? That's all coming back, would be your guess.
Yeah, I would say probably in 13 to 15 months, we'll see bidding war situation again. So in the next 3 to 6 months, if you do not own a home and you can qualify, get in now.
Yeah.
Get in now off a seller paid closing costs with a seller paid 2-1 buy down. To Tony's point, we can use those credits when you refinance to reduce the principal balance. And
you don't lose that money. That's what's
you
cool
don't
about
lose
it.
that money.
Yeah.
So I think we're over a year from it, but I think now's the time, especially if you have solid credit and you're renting right now, and you might just have enough money for the down payment, but not the closing costs, because you could put yourself into a 5-year wait period where the market just becomes too competitive to get what you want.
Well, look, it's the first of the year. Tax refunds are coming. Maybe that, coupled with some help from a seller, you're a home buyer.
File early next year. There's a long list of states giving credits back from the inflation periods. I think depending on the state, it's a 2 to 3 lag period from the state giving credit back. And a lot of states were overtaxing in those pandemic years. So file early. And if you're W-2'd, just file and get in line so you can get your money early and try to make a move before things shake up.
Interesting. I hadn't heard about that. Yeah. Talk to your CPA, see if you qualify. Addy, this has been a great episode.
Get on 100.
This is 100, baby.
So I'll see you on 200?
Yeah, exactly. I'll see you in a couple of years. Look, this was, we covered a lot of stuff. I hope you guys enjoyed this podcast. I hope that you enjoy it every single week because it comes out at 10 a.m. on Fridays. Please like and subscribe if you haven't already. But as I say every single week, what's really more important than that is letting someone know. I mean, my business over the last 26 years has grown based on referrals, people telling people about the services I provide. Please tell people about the Market Shares podcast. If you get value from it, they might as well. And Addy, thanks, man, for the inspiration to start this thing. Thanks for coming back. Well,
100
for the first and the 100th episode, and let's roll on, you guys, to 2024. See you next time.